nothing looked broken that morning. The pen was heavy. The paper was clean. The banker's smile was controlled, almost ceremonial. Outside, Tokyo was still glowing with the confidence of late 1989, as if the country had solved prosperity itself. Office towers traded at absurd valuations. Tiny plots of land were discussed as if they were sovereign treasures. Families stretched for apartments they could barely afford because everyone around them believed the same thing: buy now or be locked out forever. So you signed. A 35-year mortgage, decades of future labor converted into one irreversible commitment. The monthly payment looked manageable on paper. Promotions would come. Bonuses would come. Property would rise. It always had. That was the story. Not a theory, not a gamble. A social fact. And then the system changed. Not in the dramatic way people imagine. No sirens. No overnight national ruin. Just the tightening of money. A puncture in speculation. And then a long grinding separation between price and debt. The apartment began losing value. The loan did not. Year after year, the collateral sank, but the obligation remained fixed, cold, and exact. That is the part most people never prepare for. A crash is visible. Negative equity is intimate. It follows you home. It sits at the dinner table. It changes whether you have children, whether you change jobs, whether you move cities, whether you sleep. What happens when you owe the peak price on an asset that no longer justifies the debt? What happens when the thing you were told would make you secure becomes a mechanism of slow financial confinement? Japan answered that question over the next 3 decades. This was not just a market correction. It was the quiet demolition of a national assumption that land was safety, that leverage was rational, and that time would rescue anyone who bought at the top. For an entire generation, it did not. And that is why Japan matters now. Not because history repeats cleanly, but because debt traps obey the same mathematics, even when the language, the country, and the excuses change. Before the fall, there was certainty. Not the cautious kind, not the probabilistic language of risk. Something closer to doctrine. In Japan, it was called the land myth. The belief was simple: land prices do not fall, not meaningfully, not systemically. There might be pauses, small corrections, temporary softness. But in a country with limited space and rising economic power, land was treated as a one-way asset. Permanent scarcity meant permanent appreciation. That idea spread quietly, then completely. Banks lent against it without hesitation. Corporations used it as collateral to expand. Families stretched their incomes to secure even the smallest foothold. And because prices kept rising, the belief reinforced itself. Rising prices became the proof. By the late 1980s, this logic reached an extreme. Land underneath the Imperial Palace was famously said to be worth more than all the real estate in California. It sounded absurd, but few dismissed it outright. Because the numbers, however distorted, were still going up. This is how bubbles mature. Not when people feel greedy, but when they stop feeling uncertain. At the household level, the decision felt rational. Renting meant falling behind. Owning meant participating in a system that had never visibly failed. Employers were stable. Wages were expected to rise gradually. Debt, even large debt, was considered manageable because the asset itself would carry the burden. But beneath that confidence was a structural fragility. The entire system depended on continuously rising collateral values, not just for profit, but for stability. Loans were issued based on appraised land prices. Businesses expanded based on those valuations. Banks' balance sheets were quietly anchored to an assumption that had never been stress-tested at scale. And then a simple question begins to surface, usually too late. What happens when the price stops rising? Not crashes, just stops. Because the moment appreciation disappears, the logic reverses. The same leverage that amplified gains begins to amplify pressure. Borrowers who expected their assets to outgrow their debt are suddenly exposed. Refinancing becomes harder. Collateral becomes less reliable. Confidence, once invisible, becomes the only thing holding the system together. And confidence is not a durable asset. The most dangerous phase of a bubble is not the peak. It is the moment just before participants realize the assumptions are no longer true. In Japan, that moment did not arrive as a shock. It arrived as hesitation, fewer buyers at the margin, slightly longer selling times, small price reductions that were explained away as temporary. The narrative held, but the mechanism had already begun to weaken, and once that shift starts, it rarely reverses, because a system built on the belief that prices cannot fall has no internal defense when they do. The shift did not begin in real estate. It began with money. In late 1989, the Bank of Japan made a decision that, at the time, looked technical, necessary even. Asset prices, especially stocks and property, had detached from anything resembling income or productivity. Speculation was no longer contained, it was systemic, so the central bank tightened. Interest rates were raised in a series of steps. Not extreme, not shocking, just enough to change the cost of borrowing, enough to slow the expansion of credit that had been fueling the entire structure. And that was enough. Because bubbles do not collapse when something breaks. They collapse when the conditions that allowed them to expand are quietly removed. Higher rates changed behavior at the margins first. New buyers hesitated. Speculators found financing slightly more expensive. Deals that worked at yesterday's rates no longer penciled out. The flow of easy credit began to slow. Then it stopped feeling like momentum. The stock market reacted first. The Nikkei 225 peaked at the very end of 1989, near 39,000. Within months, it began to fall. At first, it looked like a correction, then a deeper correction, then something else entirely. Real estate followed, but more slowly. Property markets do not reprice instantly. Sellers resist. Transactions thin out. Prices become unclear. But underneath that surface stability, something critical was already happening. Liquidity was disappearing. Fewer buyers, fewer loans, fewer transactions, and in a system built on ever-rising valuations, the absence of buyers is not neutral, it is destructive. Because price, in the end, is not what something is worth. It is what someone is willing and able to pay today. As credit tightened, that number began to fall. Then the feedback loop began. Falling asset prices weakened collateral. Weaker collateral made banks more cautious. Cautious banks reduced lending. Reduced lending pushed prices down further. Each step looked rational on its own. Together, they formed a downward system. But here is the part that turned a market correction into a generational trap. The debt did not adjust. Mortgages written at peak valuations remained fixed. Corporate loans tied to inflated land prices remained on balance sheets. The entire system had priced risk as if the upside was permanent, but the downside when it arrived was absolute. For households, the realization came slowly. An apartment purchased at the peak was no longer worth what was paid. Then it was worth less. Then significantly less. But the monthly payment did not change. The loan balance did not shrink fast enough to match the falling asset. This is where the psychological break happens. Because a falling asset can be tolerated if the liability moves with it. But when the liability remains fixed, every decline in price increases the gap between reality and obligation. You are no longer building equity. You are servicing a past price, and once that gap becomes large enough, behavior changes. People stop spending. Not out of fear, but out of necessity. Every extra yen is redirected toward stabilizing a balance sheet that no longer stabilizes itself. Consumption falls. Investment falls. Growth slows. This is how a financial event becomes an economic condition, not through panic, but through adjustment. And by the early 1990s, Japan had entered something far more persistent than a crash. It had entered a balance sheet recession. A recession usually begins with fear. This one began with arithmetic. When asset prices fall but debt remains fixed, the problem is not confidence, it is math. The private sector households and companies moves from expansion to repair, not because they want to, because they have to. This is what later became known as a balance sheet recession, a term closely associated with Richard Koo. The mechanism is simple, but its consequences are slow and severe. Before the crash, borrowing made sense. Rising asset prices increased net worth. Debt was a tool. After the crash, that same debt becomes a constraint. The priority shifts from growth to survival. Every unit of income is redirected toward reducing liabilities or maintaining solvency. And when millions of households make that shift at the same time, the entire economy changes behavior. Not dramatically. Quietly. A salaryman in Tokyo still boards the train each morning. The office still opens. Shops still operate. But something subtle has changed inside each transaction. Spending decisions become defensive. Purchases are delayed. Upgrades are postponed indefinitely because the balance sheet is damaged. Consider a single household. They bought at the peak. Their apartment is now worth 30–50% less than the purchase price. The mortgage remains unchanged. Selling would lock in a loss they cannot absorb, so they stay. But staying has consequences. They cannot relocate easily for better work. They cannot refinance into better terms. Because the collateral is weaker, they cannot access additional credit without increasing risk. Their financial life narrows, so they adapt. Vacations disappear first, then discretionary spending. Then long-term plans, education, expansion, risk-taking are slowly deferred, not canceled outright, just pushed further into a future that never quite arrives. Now multiply that behavior across an entire country. Consumption declines, not because prices are high, but because balance sheets are impaired. Businesses see weaker demand, so they stop investing. Wages stagnate because companies are no longer competing aggressively for expansion. Hiring slows, promotions thin out, and this creates a second layer of pressure. Income stops growing, which means the fixed debt becomes even heavier over time, not lighter. This is the deflationary trap. Prices drift downward, wages stagnate, debt remains constant. In real terms, the burden of that debt increases every year. Even without new borrowing, the system tightens around existing obligations. From the outside, it does not look like collapse. There are no mass shortages, no immediate institutional failures. Infrastructure remains intact, daily life continues, but the energy of the system is gone. Growth becomes difficult to restart because the private sector is no longer trying to expand. It is trying to heal. And healing takes time when the injury is systemic. For Japan, that time stretched across decades. The phrase "lost decade" was used early on. It sounded temporary. Contained, it was not, because the underlying condition was never fully resolved. Asset prices did not rebound quickly enough to repair balance sheets. Debt did not disappear fast enough to restore flexibility, and each year of stagnation reinforced the behavior that caused it. Spend less, borrow less, risk less, survive. This is how a financial system transitions from optimism to preservation, not with a crash, with a slow, disciplined retreat from the future. The verdict did not arrive in a single year. It accumulated. The Nikkei 225 did not reclaim its 1999 peak for 34 years. An entire working life passed between peak optimism and nominal recovery, and even that recovery, when it came, did not erase what happened in between. Because time, in a debt trap, is not neutral. It compounds damage. Real estate told a similar story, but more quietly. Prices did not collapse in one clean line. They eroded. Year after year, small declines that never quite reversed. In major urban areas, land values fell for more than a decade. In some regions, they never meaningfully recovered at all. Now step away from charts. Look at behavior. A generation that entered adulthood believing in permanent asset appreciation became a generation defined by caution. Home ownership, once a symbol of progress, became associated with risk. Leverage, once normalized, became something to avoid. Even when interest rates later fell to near zero, borrowing did not surge the way policymakers expected, because memory had changed. This is the part models struggle to capture. Once a population experiences prolonged balance sheet damage, it does not quickly revert to risk-taking. It adapts structurally. Preferences shift. Liquidity is valued differently. Stability becomes the objective, not growth. And this is where the uncomfortable comparison begins. Today, in multiple countries, household debt sits near historical highs. Mortgages stretch across decades at valuations that assume stability, if not continued appreciation. Commercial real estate in several major economies is already showing signs of stress, declining occupancy, falling valuations, refinancing pressure. The surface narratives are different, but the structure is familiar. High asset prices supported by extended credit, confidence that refinancing will remain available, assumptions that income growth or inflation will ease the burden over time, and beneath it, the same untested question: what happens if prices stop rising and stay there, not crash violently? Just stagnate or drift downward while the debt remains fixed, because that is enough. Japan demonstrated that you do not need a dramatic collapse to produce long-term financial constraint. You only need a persistent mismatch between asset values and liabilities. And once that mismatch locks in, the system changes character. At that point, the question is no longer how to grow wealth. It becomes how to preserve what remains functional, which brings us to the quiet outlier in this entire period. The asset that did not collapse, the one most people were told to avoid. It did not produce yield. It did not appreciate dramatically. It was not admired. But it worked. Cash. In a system where asset prices were falling and debt was fixed, cash gained something most people overlook: relative power. Each year of deflation increased what it could buy. Each year of stagnation increased its flexibility. While leveraged assets trapped their owners in past valuations, cash remained anchored in the present. Liquid, uncommitted, optional. That difference mattered. The households that avoided heavy debt had room to move. They could relocate for work. They could adjust spending without negotiating with a bank. They were not forced to hold declining assets simply to avoid realizing losses. They endured the same economy, but not the same constraints. Renters, often dismissed during the boom, retained something owners lost: freedom. This was not a victory story, it was a survival distinction, because in a deflationary environment, the goal is not to maximize returns, it is to avoid irreversible positions, to remain adaptable while others are locked in place. That is the pattern Japan leaves behind. Not that cash is always superior, not that property always fails, but that in a credit-driven peak, leverage converts uncertainty into obligation. And if the system shifts, that obligation does not adjust with reality. Look at the present carefully. High debt levels, long-duration mortgages, asset prices that depend on stable financing conditions, early signs of stress in parts of real estate markets. None of this guarantees a repeat, but it does not need to. The mechanism is already visible, so the decision becomes quiet but precise. Continue trusting that time and policy will protect leveraged positions, or begin reducing fixed obligations, increasing liquidity, and preserving flexibility before the system forces that adjustment under pressure. Because when deflation arrives, it does not announce itself. It simply removes your ability to wait.